government touches is usually done worse than if it's done by the private sector. That is a basic principle of the market economy of the capitalistic system.
I think clearly there's a social trend here that people are upset with government. It's much like the 70s, actually. Big government. We have that people got fed up with the banks, and rightly so. And the banks hasn't been playing the PR game particularly well either. And at the same time, governments are just, as Marc said, dirigism is a new word. I mean, the French version of like state intervention at every single level. And they think they got an all-out plan for solving the crisis at hand. And the problem is it's public capital is crowding out private capital, which means the return on the private capital is diminishing. Instead of what we actually need right now is for the market to go for the highest margin return on capital. So like Marc's saying, we're in a world where we have infinite amount of supply of money at zero rate. Everything should have an infinite valuation. And that makes no sense. I mean, you can just start the businesses all over again. And in many markets, credit, despite the credit constraints, like in the mortgage markets, credit is still too available relatively to what it should be in terms of what the income is.
It's all well and good, isn't it, to blow the free market trumpet at this point. But quite frankly, the governments had no option, did they, at the worst moment of the credit crisis? Otherwise, we would have seen more people thrown out of work as corporates reacted disproportionately to the fear of basically losing credit lines at that point.
Yes, I am familiar with this line of argumentation. The Keynesian will all say it would have been much worse had the governments done nothing and we would be in a depression today and so forth. But it's not obvious to me that this is correct. First of all, everybody always, day in, day out, tells me about we have to avoid deflation. Now I'm here in London, I pay something like £470 for a room for one night. The hotel is okay, but I mean, it's not exactly a palace and extremely luxurious. I would be very happy if we had deflation. I would only pay £100 for that room. And so I tell you, when people tell me about deflation, everything I spend, whether it's my first class tickets or business class tickets, my hotel bills, my food, and by the way, in emerging economies, food prices are rising at close to 20% annual rate. So when people tell me about deflation, I think it would be very good for the world to have deflation. Then you and I could go and buy houses at very low prices. We could buy distressed debts at low prices. If the S&P was at 500, I would buy a lot of S&Ps. But at this level, I'm not particularly interested to buy anything. And I buy gold in absence of knowing what else to buy. And I'm very interested. I mean, Steve is a smart guy. You have today $1 billion. What would you do with it?
I would obviously, I will take some in gold because of the fiat system, as we both believe in will fall. I will certainly be buying grains long term. I think we are at a turning point, and I will invest massively in that sector. I mean, if I had $1 billion, I'd certainly go buy actual physical land.
Yeah, farmland.
Farmland, yes. Absolutely.
And we can become farmers together.
Yeah. Demographically, we're at a turning point, but basically production can be ramped up in grains. I would look at a basket of dividend yields because you just definitely need equity to pay that, but there'll be global brand names which have access to credit markets, but I think it's essential. And then I will be massively investing in small cap, because small cap is private equity with transparency, and that's where the money is, because I've invested personally like in a silly business like headhunting, and that's the return is
we'll just come back to this. No, this is not Hollywood. This is not the red carpet premiere for some movie that you're desperate to get to the cinema to see. This is the press waiting with bated breath for European leaders to arrive, to explain to us how we're going to get out of the sovereign debt crisis in Europe in a one-day summit. 2 days. In a one-day summit, they're going to solve it. Of course they're not, are they?
Of course they will. Just print more money.
Just print more money.
Yes.
That's the solution. And you're just convinced, aren't you, Marc, that the politicians will not be able to help themselves? Print, baby, print. Let's go.
The ECB will talk hawkishly, but act dovish, like the Fed in the US. And by the way, I want to mention one more point. Now that the US dollar has been strong, it gives another leeway to Mr. Bernanke to ease again, because the last thing the US really wants is to have a strong dollar. They want a weak dollar, and the Europeans basically, they're quite happy with the exchange rate where it is at the present time. Not the Swiss, but the Europeans are quite happy where it is, because when the euro went to 151 against the US dollar last November, Europe became relatively less competitive. So everybody in the world wants a weak currency, basically. And what does it lead to is that the strong currencies like gold and silver eventually will trade higher. Now, can they correct 10-20% easily?
Yeah.
Can happen. Anything is so volatile.
Richard writes in and he says, the majority of people I suspect are like Marc Faber. He's not polite to you, Mark. He says they do not understand how the economy really works. If private sector companies and individuals are unable or unwilling to take on more fictional credit money being offered, then no matter what central banks do, they are doomed to failure. The so-called pushing on a string here, Mark, even if they print, we will not spend it.
Well, that depends. I mean, let's say if I send you a check of $1 million, it is likely that you will spend a little bit of that. You understand? You're not going to save it all. Or if you save it all, then you repay debts, and then you move into a better position to spend at a later stage. But I don't believe that the Japanese model 1989 to today is representative. First of all, they didn't print enough money. They could have printed more, but at the cost that the yen would have been weak, and at the cost of a lot of other unintended consequences. And by the way, people who tell me about the great deflation in Japan, why don't they go once and stay in Tokyo? It's still one of the most expensive cities in the world. A taxi from the airport to the city is $250.
Pleasure.
That's the great deflation in
Mark,
Japan.
We've got to let you go, but thanks so much for being with us this last hour. Steen stays with us.